Last episode, we talked about the general framework of an RRSP. Today, we're going to work through some very simple examples to show you when an RRSP looks more or less attractive. There's going to be some math, but not a lot. Hey everyone, I'm Preet, and this is Mostly Money. If you recall from the last episode, an RRSP is a giant tax deferral tool. Save tax up front when you make a contribution, but pay tax when you take it out down the road. To demonstrate when an RRSP looks more attractive and when it should be avoided, we're going to compare three scenarios. Scenario 1, your tax rate is the same when you make a contribution and when you're retired. Scenario 2, your tax rate is high when you contribute but lower when you're retired. And scenario 3, you're in a very low income bracket when you contribute and when you're retired. To make it very simple, we'll use the following assumptions. You make a single contribution of $1,000 to your RRSP, it doubles in value by retirement, and then you take it all out. Let's start with scenario 1. Your tax rate is average, we'll say 30%, and doesn't change between now and retirement. Your $1,000 RRSP contribution will generate $300 in tax savings up front. The $1,000 invested doubles to $2,000 by retirement, and then you take it out, at which point, remember, it is subject to tax, so you lose 30% or $600 in tax. That leaves you with $1,400 to spend. Now let's look at scenario 2. In this scenario, your tax rate is higher now, 40%, and you expect it to be lower, say 25%, in retirement. Your $1,000 RRSP contribution will generate $400 in tax savings up front. The $1,000 again doubles to $2,000 by retirement, and you lose 25% or $500 in tax upon withdrawal. That leaves you with $1,500 to spend. And now we're going to look at scenario 3. What happens if you're a very low income Canadian? And by very low income, I mean that you will qualify for the Guaranteed Income Supplement, the GIS. What you need to know is that the GIS is a benefit that is income tested. And what that means is that the higher your income, the lower your benefit will be. In this case, every $1 of income can lower your GIS benefit by 50 cents. That's essentially a 50% tax on top of your marginal tax rate. As a very low income Canadian, let's say your tax rate is 20% now and in retirement. Your $1,000 RRSP contribution generates $200 in tax savings up front. The $1,000 again doubles to $2,000 by retirement, and you lose 20% to income tax, or $400, upon withdrawal. Plus, you could lose 50 cents of the Guaranteed Income Supplement for each dollar of withdrawal. That's $1,000. That leaves you with only $600 to spend. So if we do a side-by-side comparison of our three scenarios, Scenario 1, an average tax rate that stays the same now and in retirement. Scenario 2, a high tax rate now and a lower tax rate in retirement. And Scenario 3, a very low income Canadian who is eligible for the GIS. In Scenario 1, you save $300 in tax up front, pay $600 down the road, and ultimately have $1,400 to spend. In Scenario 2, you have $400 in tax savings up front, you pay $500 down the road, and ultimately have $1,500 to spend. And Scenario 3, you save $200 in tax up front, effectively pay $1,400 down the road, and ultimately have only $600 to spend. The takeaway is that RRSPs look more attractive if you're in a high rate now and expect to retire into a lower rate. But if you're a very low income Canadian, you may want to avoid RRSPs altogether. I'll post a link down below for more information on what qualifies as very low income if you're not sure. And if I've confused the hell out of you, just use a tax-free savings account for now and get on with your life. Speaking of which, in the next video, we're going to talk about the tax-free savings account. See you then, and thanks for watching. Hey guys, thanks for watching Mostly Money. I hope you enjoyed today's show. Don't forget to subscribe to my channel by clicking on the button in the bottom right-hand corner of your screen, the little thing that says subscribe. There are lots of videos to explore on my channel, like this one. So if you want to learn more about money and personal finance in a fun way, check those out. If you have any questions for me, you can reach out to me on Twitter at Preet Banerjee, or you can leave your questions and comments down below in the comments section. That's it for today. See you next time.